G'day all, g'day tankers. This is Joel Seach, Principal Advisor.
Tankers, this is Arnie, Tax Professional.
And this is Money in the Tank. And this week's episode 7, we're going to get into that meaty fact of diversification, what it means, how it works, how it best suits certain people's needs and investors' needs.
That's it, and we've got my favourite segment, Rivkin's Rules, and we've got some really good Q&A coming in, so please keep it coming in. And we've got a really good 50-50, which is listener submitted. So if you want to submit a 50-50 and you want to keep the questions coming in, the best channels to hit us up on are Facebook, Instagram, Twitter, or the YouTube comments. That's Money in the Tank, at Money in the Tank on all of them.
Listener's choice 50-50. Love it. All right, crew, enjoy.
Peace. All right, welcome back.
Yeah, g'day all. Welcome back again to next episode 7, I believe, Arndog, of Money in the Tank.
Yeah, episode 7, and just due to some scheduling difficulties between us and our producer, we're probably going to be releasing this on Easter weekend, and I'll put that up on the social media so people will be aware once you're hearing this, probably.
Yep, so you'll have to be patient while it comes out and while our producer gets it organised. But we've loved doing it for you guys, and we've loved getting all the feedback. It's been great, and it's been enjoyable to be able to get some of our impart some of our knowledge out to the world, there, out to the audience.
That's it, mate. And then so this week we thought we'd focus on diversification for this episode, and then the next one, which will be released shortly after, will be on inflation, which kind of hinges off diversification.
Absolutely, yep. So we'll get stuck into that, and it'll all be obviously, as per always, general in nature when we're discussing anything to do in this podcast. So always seek personal advice whenever it's your own personal situation. But before we get into actual topics of money, we've got to jump into our favourite book, Arnie.
My favourite segment, Rivkin's Rules, the Money in the Tank Bible. Have you got a perler for us, Jolie, or what?
As I said last week, I'm going by the seat of my pants in terms of I'm just flicking through the book here, and you'll hear the book flick as per last week, and we'll be able to hear exactly which page we land on, and I don't know what's going to come of it. We never know what Rivkin's going to tell us.
No doubt it's going to be good.
All right. Here it is. There is no better place to be poor than in Australia.
All right. Okay.
There you go.
What do we infer from that one? I guess the quality of living in Australia is very good for all classes. Is that what Rivkin's trying to say?
Yeah, it looks like it's a page on sort of economic prosperity. So, economic. He says the quote above it, you get 2 quotes for one this week, ladies and gents. Quote above it is, economic prosperity has far more to do with economic cycles than good political policy. So maybe a bit of a shot of politics there as well on the one page. So there's only 2 quotes a page, or sometimes just one. So that one there is, talking economy, I guess, and talking about Australia as a fairly wealthy nation, even back in 99, considered a fairly wealthy nation. I guess, I've reckon a pretty good point there from what we've been through recently with this pandemic. Our nation as a developed economy has done so well from the recovery overall, more broadly. Obviously, key specific industries are still, have really copped it quite hard. But more broadly, our unemployment rates coming down, and our recovery is going quite well. And we've been able to, help people through that gap. We're able to help people get through that period of time with JobKeeper and Job Seeker to be able to fund that from a strong government or economy, I should say, and balance sheet is pretty crucial.
Yeah, that's a really interesting quote from Rivkin, a good Rivkin's Rule segment as always, and it's made me start thinking about it. And money in the tank in general, I guess, doesn't really matter where you start. It's where you set your goals and where you're going to end up, and that's what we're aiming to help and educate and facilitate. So, yeah, I love that from Rivkin, and good points from you, Jolie. We're in the lucky country, but to any of our listeners who are not in Australia, we're going to try and help you get where you need to go as well.
Absolutely. We'll create a path for them and help them with some tips and tricks along the way to help them along their wealth journey, investment journey. So Rivkin was actually an economic sort of investment related one today, not just a random Rivkin quote.
I love it, and I love that it kind of ties into diversification in a way, and we'll sort of touch on that as we go. I think maybe I'll kick this off with diversification. And when I'm thinking about diversification, Jolie, my mind goes back to university, and I remember learning about types of risk. And if I could just bundle them into the 2 types, I mean, there's more than 2 types, but overarching kind of umbrella terms, you've got systematic risk and unsystematic risk. So systematic risk is like known as market risk, and it focuses on things like political risk or macroeconomic risk or interest rate risk or inflation risk or currency risk, liquidity risk, etc. And then unsystematic risk or specific risk, which is the one that you can diversify away, is risk that only affects like an industry or a company, like a specific company. So it might be something like a change in management or a product recall or a regulatory change in that industry or new competitors entering the market, which might, threaten some of the market share. So those are the types of risks that we'd be looking to manage through diversification. Although I would say that diversification can help you, I guess, a tiny bit with systematic risk, and it's kind of more about the strategy you employ at that point.
Yeah, it's a really good foundation explanation there to diversification and the risks that are involved with any type of investing. And it just came to mind then that diversification can drill in so deeply into, even two stocks that might look similar could be completely different from a management or a diversification or a competitive standpoint. And an example, I guess, of diversification, just in a really an easy to understand or follow one. Let's say you're in the 90s, you're out at your local Blockbuster or Video Easy, and you think early 90s, you think, geez, this is a good business model. I'm gonna pack a bunch of wealth into Blockbuster stocks. I'm gonna buy up big because I'm loving these Friday nights, and look, they're all sold out, and I'm going to own this for the next 20 years and never look at it again, which, you sometimes you can do with stocks if they've been around for a while. But in general, if you were to do that and just, close your eyes and wake up and we're now into the, let's say we're into the 2010s, you start to see these video stores vanishing and going, and you're like, wow, what happened there? These were so popular. But essentially, what's happened is technology's changed and the market's changed and the demand for certain things has changed. So you've got these competitors that have come in, and these streaming services, which you wouldn't have even thought about in the 90s, have now come in and essentially taken away a lot of Blockbuster's customers. And they're now with your Netflix or your Stans or whatever other streaming services you listen or, you watch, I should say, Disney. So essentially diversification over that period of time. Let's say you owned 50% of Blockbuster, and then Netflix came in and you're one of the early adopters to Netflix, and you got you sold half of your Blockbuster because you thought, okay, well, I'm going to diversify because I could see this being a threat or a competitor. I'm going to put half the money into Netflix. That's a way of de-risking yourself with diversification from one asset that you think or company that you think is a company that you want to be in, but diversifying it to say, well, I'm going to go into something else that looks like a competitor, but is it going to be a different trajectory, as opposed to staying in just the one company that has this obviously ended fate, which is I think the last one closed down last year. So it's just a really, I guess, when you were talking about that, Arnie, it just made me think of a cool example to talk about. With a Netflix and a Blockbuster example of diversification of that.
Mate, do you know, I love that you brought that up, because I think I read somewhere during the week that Blockbuster actually is still existing, and they've started a new business model, and I think it's only happening in America at the moment, where they've got kind of like those old newspaper bins where you can sort of open it, you pay $1, you open up and you get a newspaper out. But nowadays you can actually go to the bin and you can get like whatever you want to watch from this Blockbuster bin. But I need to do a bit more reading about that because I only sort of caught it in passing. But I love your example, and what Jolie's touched on sort of gives us a level of nuance into diversification. So if I take a step back and say, what is diversification? It's basically taking your money that you want to invest and you want to invest it across different asset classes. So if I'm saying different asset classes, I mean like shares, property, bonds, private equity. And the reason that you might want to diversify in your portfolio is because you want to smooth out or make your returns more stable. And you're doing that because different risk is inherent in those different asset classes. But Jolie went a step further and was giving you an example of how you can diversify within the same asset class almost. I guess if you're buying stock in Blockbuster and buying stock in Netflix, then you can even diversify at that level. So another good example of that is diversification. I'll use stocks as an example. Say you own a bunch of healthcare stock, well, then you may want to also own stocks in consumer goods, stock in industrials, stock in financials, or fintech, and you're diversifying within that asset class. So the whole point of it is to make sure that you don't lose money in a concentrated portfolio. Like if you were only to have exposure to shares and you didn't own your own home or you didn't have an investment property, and the share market were to crash, then on paper you will have lost a lot of money. And if you don't have the time horizon available to recover those paper losses, then, or if you need the money for something, then you might have to realize the losses. And that is the risk in not diversifying and in concentrating. So I think it's a good little segue into what are some of the things that you can diversify into. Do you have a few off the top of your head, Jolie?
Yeah, so some great points there, Arnie. And when you talk about diversification and options, are you mainly talking from a broad perspective, Arnie, of like an asset allocation diversification? Is that what you're meaning there?
That's what I was getting at. And I guess later on we can touch on how you might want to balance those assets within a portfolio, or like when is the time to buy more or sell? Is that where you were heading with that?
Yeah, well, I guess a diversification inside of a portfolio as at a high level is you can have a bunch of different assets make up your portfolio. And, you know, when we're talking general in nature, obviously some people have more of a tighter portfolio, so they might only own a few certain stocks or a few investments or properties or startups, and because they may specialize and niche in that area, and they might do very well out of that. So we're not necessarily talking to investors that go that route, and that they may have good success, but we're more broadly speaking from a Joe Blogs type perspective to say, okay, what's some 101s for diversification, and if we're not taking an active interest, how do we best spread our money around to help minimize the impact of those downturns that we may get in certain sectors or industries?
You've touched on a good point there, because diversification, like, is it right for you? Like, it kind of depends on where you're at in your investing journey, because there are some downsides to diversification. If I could jump in there, I know I asked before for some different asset classes you could invest in, but if I could just touch on some of the downsides, it might be hard to manage a diverse portfolio if you're just starting. Like, if you've only got a small amount of money to invest, and it may not be worth it to invest that in multiple holdings straight away. And then at the same time, you're going to have to think about how it's going to affect your bottom line. Like, how much are the transaction fees or the brokerage charges for getting into all of those assets? I think ASIC might recommend like 30 stocks in a portfolio is a good number for diversification. But if you can imagine spreading your first $5,000 investment across 30 stocks, you're going to get hit pretty hard in fees and brokerage charges there. So that's just something you have to be mindful of with diversification, that, once your portfolio is established, it's a good way to protect the downside of those risks that we mentioned. But you sort of need to think about where you're at.
Yep, no, really good point. And the ASIC Money Smart website's a good one that I recommend clients go to as well for just general information. It's very handy. But yeah, diversifying when you're only starting out or only have a certain amount of funds to invest can be really hard to do, which is why we've spoken before about different options to investing in portfolios that are already established and ready to go, and you just drip feed money in. But we've got actually a Q&A on that later on, so we'll cover that off a bit more. But yeah, you can actually over diversify if as you said, if you only got 5 or 10 grand and you're trying to get in, and you're wanting to spread through all those stocks. It does cost a bit when you're buying and selling. So you may slowly build diversification into your portfolio, which will help over time. So diversification back on the asset classes that we spoke of before. You've got a range of different asset classes that you can diversify into. So you've got your cash and your bonds. Aussie government bonds and corporate bonds. You've also got Australian shares. Inside of Australian shares, which we've done on Shares 101, you've got your small cap companies, you've got your mid tiers, and you've got your blue chips, your bigger end. And same with international shares. International shares, sometimes you think Australian shares is sort of the one that you hear about the most, but international is so broad. There's so many countries and companies around the world that you may not have ever heard of, but that's another way of diversifying a portfolio. You've got property, you've got domestic and international property, you've got infrastructure. So there's so many different commercial property. You've got so many different asset classes in there. And property, which we probably haven't spoken on just in this podcast yet in diversification. Property, you've got residential property, you've got commercial property, but you can also have, residential property as an example, as we mentioned before, is it can be different per state. So you can be in a property in one state, it might be a different property to another state. An area or a suburb of that state may cater or need a property of a different, like let's say a townhouse as opposed to a region might need a house with land. So diversification and catering for whatever investment you're needing or in a property standpoint, catering for the audience or the tenants you're trying to appeal to or the growth you're trying to achieve. Diversification in your basket of investments is very handy because it does actually help when things go awry. So as an example, with commercial space for the moment, with office buildings in the city, there's the vacancy rates would probably be up, would be my guess. I haven't checked for a little while because so many people are working from home. The need for office footprint isn't as desperate at the moment, whereas a commercial property potentially in an area like a factory or a space that might be producing something in a certain area is in more demand because they've had an uptick in demand for their product. So commercial is different to resi again. So residential is, people are demanding, they want to live in a certain area, so the rental demand's high. So diversification can really be drilled into so many different areas. So that's what we mean by it's not necessarily for everyone, however, and maybe even not when you're starting out, but it's good to understand the risks associated with investing purely just in one asset class or one particular area. If that area does take a hit over time, it may never take a hit, but if it does take a hit over time, you've got some downside risk protected for yourself.
That's right. And I think just touching on taking it back a step to the asset classes you were mentioning, a few other ones are managed funds. And I think, Joel, you said property, but that also includes your own home. So if you own your own home, you're diversifying a little bit there. And also a big one in Australia is superannuation, which we've touched on a little bit last week and we plan on doing in a future podcast. But if you're investing through your super and your employer has to, then you're already getting good diversification there because they typically have a balanced portfolio option which will invest in those different asset classes that Jolly was mentioning automatically. So that's a good thing. One of the examples which I remember from uni, and you jogged my memory just then, Jolly, because I read a different example about America. And so I'll run through both. My tutor in university was saying, when he was giving an example of diversification was, you're heavily invested in the ice cream market and over summer you crush it, you do so well. But then in winter, you realize that just ice cream sales aren't cutting it. So you decide to diversify into coffee. And then all year round, you're doing well in one of the asset classes, which I love that example. And it I was watching this podcast myself during the week, or maybe a vlog, and they were talking about how in America at the moment, they've got issues with their supply chains. And in particular, it's air travel, air freight and boat freight. So it kind of brings you back to the correlation within different asset classes or different industries and how you might think to yourself, well, I'm gonna invest in in the air travel space or the air freight space, but I'm also going to invest in the railroad space. And then something like a pandemic comes along and wipes out the thing that you thought you had diversified is actually wiped out because there's a strong correlation in those industries. So it's just there's a lot of nuance in this topic which you need to be mindful of. But I think the takeaway is, if you've got a portfolio that's getting on the larger size and you want to do your best to protect some downside risk and protect your money, then diversification can help. But yeah, there's a lot of choice, and you just got to sort of go with it.
Yeah, and I think probably to summarise, or one of the other key areas, if we are going to look to summarise, is you mentioned their correlation and uncorrelated assets. So that's probably one of the things that you do look at when you're investing, and when you're an investor or an advisor, and you're trying to look at ways to find asset classes that don't tend to move together. So what I mean by that is, the Australian market and the Dow Jones correlated to an extent. The Australian market will tend to track or follow what the Dow Jones has done, which is the Dow Jones is the American index, and the All Ordinaries or the ASX is the Australian index. If you haven't listened to Stocks 101, go back and listen to that podcast. But they tend to track each other, to an extent. But the All Ordinaries hasn't gone up as much as the Dow Jones has. It's a slightly different market, but that's an example of fairly correlated asset class. Whereas you might have an asset class that is different of how it moves. So let's say gold and Australian stocks are slightly different. Or we mentioned last week's podcast was Bitcoin. How's that going to be over time with being correlated or uncorrelated to stocks? So that's going to be a really interesting one to keep an eye on, because does that open up the opportunity to have something that's going to move in a different direction? When one part of your portfolio is going one way, you've got another part that may be going in a slightly different direction, which can help out with smoothing those returns and smoothing out your bumps along the way.
Yeah, that's right. And the final point I wanted to make about diversification is the balance in your portfolio. So over time, different assets are going to appreciate or depreciate. And as that happens, the risk might go up in a certain asset class that you're invested in. So you need to think to yourself about rebalancing. And what I mean by that is you can either take extra money you've got on the sidelines and you can put that into those spaces that need some more exposure, or in one of the ones that's appreciated a lot comparatively as a percentage to the rest of your portfolio, you might be able to sell down some of those investments, realize the gains, and then account for everything you need to do properly. But then you can put the rest of that back into those other types of investments that need a bit of a bump up to keep the diversification working well for you.
Yeah, for sure. Overweight and underweight in certain areas sometimes can be hard, as we've spoken about before, with investing, the emotional standpoint of something. If something's doing well, sometimes your habit is to think, I'll put more into that because it's doing so well, but it may not necessarily be next year's best winner, and the ones that maybe haven't done as well this year could end up having a better year next year.
And that's the psychological effect. Like, the moment you sell out of a stock, it's going to go through the roof and you're going to kick yourself. But I feel like you just need to remember why you're invested. Time horizon, your goals, what you want to achieve. Are you still on track to achieve it? Then don't worry about any movement that happens outside of things you're not invested in. And there's always another opportunity around the corner. So it's just one of those things.
Yeah, the best outcomes investors you see, and the best ability to do it is keeping unemotional about it and trying to forget about something. If you've sold it, try to ignore it. Try not to think, geez, it's gone up now, I wish I hadn't have sold, because it is what it is. You've moved on. And if you're in something and it's going up and down, try not to think about the day-to-day swings of the up and downs. Just try to think of that medium and long-term reason why you got into that stock in the start place, or the investment in the starting place. And if it still meets that reason as to around why you got into it, then you're on the right track. You're staying there. It doesn't matter what it does day to day.
That's it. Well, I reckon we've done a pretty good job covering diversification. So if there's any questions, please feel free to hit up Joel or I on any of the channels which you might follow, Money in the Tank. And that sort of brings me to the Q&A portion. And we're getting a lot of good questions come in, Jolie. So we've chosen a couple that we like for this week. And we actually also got a listener submitted 50-50 this week.
Love that.
So
what do they ask? Do they say, do they give us a bloody name for that section, that segment?
The funny part is when they contacted us, they said 50-50 either or, what's your choice? So,
we're just going to have to stick with that as the name. The segment's got multiple names.
I think it's funny that it's got multiple names. It's always going to be one of the three. You guys know what we talk about.
I love it.
So,
and what's the best place for people to get their questions in and on the channels, Arnie, just for listeners?
Yeah, the best channels at the moment to contact Money in the Tank is Facebook, Twitter, Instagram, or you can leave a comment on the YouTube videos. That's the best place to contact us at the moment. So please keep all the questions, comments, and suggestions coming through those channels, because we really enjoy them. And we love that you are getting benefit from this. So, yeah, that's why we do it.
Cool. Love it.
So we'll jump into the Q&A. So I think the first Q&A actually touches on diversification a little bit, and we're thinking about making this our next podcast topic. So the first question was, and we can both have a crack, Jolie. Joel and Arnie always talk about, being invested is a good thing, and they both agree you should be invested. Why not leave your money in a savings account or a high interest savings account? And the answer to that is inflation. But we're going to touch on that in the full podcast, but we can talk a little bit about what that means. So do you want me to have a go first, Jolie?
Yeah, please do, mate. And obviously, when we're answering these questions for our listeners, it's always general in nature and seek personal guidance where required. But yeah, I'd love to hear your thoughts on that, Arnie, and reasons around. And I'll just, if there's anything that I feel like I can add, I'll jump in as well at the end.
All right, mate. Yeah, well, it's actually a good one for diversification because inflation, people tend to invest in things known as inflation hedged assets like gold or commodities or REITs or listed property trusts we've talked about in the past. But inflation essentially is the decline in purchasing power in a currency over time. And it's possible that you could have deflation as well, which would be the inverse. You could have an increase in your purchasing power in a currency over time, which would mean the prices of goods would go down. So in a nutshell, at a very high level, the way they measure inflation is by taking a basket of goods and services, and then in looking at those goods and services over a select time period, they'll look at the rise or fall in the levels. And if it's a rise in the level of prices expressed as a percentage, then generally that means that the unit of currency will buy less of those items today than it could have done yesterday. And again, deflation is possible. So why is that a problem for keeping your savings in a high interest savings account? It basically means that as you let money sit in that account, it's going to be losing its purchasing power. It's going to be devaluing every year by a certain percentage. Typically, it's 2 or 3% a year. So as long as you don't need that money, and we've already spoken in the past about the benefit of having an emergency fund, it's probably better to put the excess money that you don't need into some kind of investment, because that's going to be appreciating in value and probably beating inflation. Like even if you're going through an index which tracks the whole market, typically that on average returns 7% a year after inflation. So you're doing pretty good there. And that's the difference. Have I missed anything, Jolie, that you can think of?
No, I think you hit everything really well there, Arnie, and you gave a definition as to what inflation is. It's the cost of bread going up every year. The price of a loaf of bread goes up each year, or the price of a Big Mac goes up, whatever your selection is. And yeah, cash rates obviously, domestically in Australia and broadly around the world have come down, and they're so low at the moment. So what you used to be able to get in your savings account, whether it be 4, 5, 6%, up to 10 years ago, has now really come down to 0.5% to maybe 1%. And inflation, as you said, usually runs between sort of a 2% to 3% long-term average. So you're almost guaranteeing to take a hit on your earnings of your money every year in there. But as you did also mention, Arnie, which was one of the things that jumped out at me, was if you've got a short-term plan, then yes, cash is keeping it in the bank account is there for that plan to be able to achieve that plan or that goal you have. As you start to push out that timeline and time horizon, that's when you've got to be mindful of keeping that money in there over the medium to longer term, because that's when that erosion effect can take place for sure.
Yeah. Well, maybe I'll hit you with the second one that we've selected from our Q&A this week, and I'll also jump in. But the next question, which we thought was a good one to address, was, and this was coming from Chris, what was the difference between a managed fund, an exchange traded fund or an ETF, and a robo-advisor? Because we've spoken about this a couple of times now, so maybe if we do a little bit of a deeper dive into what the difference is. Can you start us off, Jolie, with one of those?
Yeah, so managed fund is you're outsourcing your money to an investment manager that will provide you with units. So you'll be provided with units of that managed fund. So let's say it's $10,000. And the units are $1 each, so you get 10,000 of those units, and then that unit price of that managed fund will go up and down every day depending on what the underlying investments do. ETF is usually a lower cost way of investing direct to the stock market. So it's an exchange traded fund, and you'll own the underlying assets of that stock. So by buying that stock, you'll be buying into that basket of stocks. Usually it tends to track an index, and I might get you to explain the differences of the two weightings they can hold in the ETFs, Arnie, the different types of weightings, I should say. And then robo-advice is more so going to do a risk profile of where you feel your risk should sit for you as a personal investor, and a robo-advisor will then take that money and invest it whatever that risk profile comes out to be. So you're sort of taking part of an advice process and just having your money invested from a robo-advice standpoint, which is appropriate for certain people for sure.
Yeah, and we've sort of touched on that in Shares 101. You got to work out what's appropriate for you. I mean, you could invest in all three and you'd have good diversification, touching on the topic of this podcast. But I think the main thing you should be looking at when you're considering these products is the cost. That's the thing that springs to my mind is how much is the managed fund going to charge? How much is the ETF going to charge? And how much will a robo-advisor charge? Because that's going to directly impact your returns. But yeah, just what you asked me to touch on, the different weighting within an ETF, Jolie. So typically you can get ETFs that will track like something like the S&P 500 in America, and you might have a market weight index versus an equal weight index. So what a market weight index means is it will have the slices of those companies in equal weight that they are in the market. So say, for example, I don't know what the biggest company in America is, but say Apple's like 33%. That's probably too high. Say Apple's like 15% of the total S&P 500 in America. Then you'd have 15% of your money in that ETF in going into Apple. But in an equal weight index, it would just take an equal weight across those 500 companies. So the slice would be the same. So, if you had $500 to invest, then you'd have $1 in each of those companies in the S&P 500. So that's the difference.
Great explanation. I love that. And historical performance is another thing as well. So you can check back at what something's done historically in terms of performance. And they always say disclosure, it's never a guarantee of future performance, but it can provide a decent indicator as well. But great explanation of the weighted indexes there, Arnie. That's good.
Thanks, mate. I'm keen as for this. I want to hit you with the listener submitted 50-50. So this comes from Barney. And Barney wants to know.
And he hasn't told me this one before either, so I'm coming in cold, which we love to do. I love coming in cold.
That is a very appropriate choice of words, because Barney's 50-50 is, when you've got leftover pizza, do you like to reheat it or do you like to eat it cold?
Yeah, great question. And the reason we do the 50-50s is because obviously in life choices, you've got life choices and investment choices. With diversification, you've got investment choices. So life choices are just as crucially important, and just as crucially important as that is pizza and what you do with the leftovers. So I must admit, if I do a pizza, it might be once every couple of months I'll do a pizza, and I tend to heat up. I heat up in the next day, so it'll be refrigerated, usually just in the cardboard box on a plate with some Glad wrap, and then always a heat up, because I've always found that heating it up the next day, it's perfectly fine. Make sure, as per, could be another 50-50 in its own, is pineapple on pizza. I'll make sure I take that off.
Oh.
But yeah, that's I always heat it up, and I find it tastes great the next day.
Mate, pineapple on pizza is a huge either-or topic. I feel like that's a podcast topic. It's
a big conjecture, that one.
Barney likes his cold. He thinks it's a totally different meal. But if I'm choosing, and this is the problem with 50-50 or either-or, because you have to choose. You can't sit on the fence. Even though, in keeping with the diversification nature of this podcast, I might have a slice reheated and a slice cold. And that's what I would do in real life. I typically do both. Yeah, I do both.
That's odd.
I have one cold and I have one reheated. But
just in the same meal. So you just sit, you get it out of the fridge and you're like, I'm going to have this cold bit, and then I'm going to heat this one up, and I'm going to eat it at the same time.
That's what I do. But you know what? There's
really odd.
There's nuance, because it also depends on what pizza I've ordered. So I like some reheated, I like some cold. But if I'm going to choose one for the 50-50, then I'm going with Barney, and I will have it cold.
Wowee, there you go. I don't reckon there'd be many people that would do one of each, Arnie. I reckon that's super odd for you. That's like my cutlery drawer being spoons in the middle back in the day. I reckon that's super strange from you. So
I love that. That's what makes us unique. I want to hear from the money in the tank. I want to hear from the tankers. Do you have it reheated or cold, or do you like one of each like me?
Yeah, no, I reckon you're the only weirdo. But yeah, that's great. So differentiating again, you and me pretty much. So I'm on the warm out the fridge heat up, and you're you prefer to lean towards the cold, and Barney, it seems like cold as well, which quite interesting to hear people's thoughts.
I'm curious now, what kind of pizza do you normally order when you do get pizza?
Usually a margarita, or probably like a special, like a supreme special. Usually take the pineapple off, usually the anchovies, unless I'm feeling a little bit risky.
See, right there, if I had those two pizza choices, I'd be eating the margarita cold and I'd be reheating the supreme.
Okay, gotcha. Yeah. So it's just the cheese, the easy one to eat cold, and then the bit more on it, you want to heat it up.
Exactly, mate. Yeah.
Love it. No, very good. Well, that seems to be one of the most popular segments. Is the people's choice on what's your choice, 50-50, either or. Let's keep them coming in. We want to hear from people, everyday life situations and struggles. So keep them coming. It's good to hear from everyone.
All right. Thanks for listening, all. That's Money in the Tank for another week, and we'll get back to you soon.
See you guys. Bye.